Hi, and welcome to another segment of Your Future, Your Finances. I'm your host, Brian Kuhn. It's been a couple months since the election. It's a good time to check in on mortgages and interest rates. Back again with us today, we have Ken Vennick of Equity Mortgage. Welcome back to the show.
Thank you. Thanks for having me.
What have happened to mortgage rates and interest rates since the election?
It's pretty much been a straight shot up. A lot of people are predicting that we would see a little bit of decrease, actually, based on Republican winning, but it's kind of turned out the opposite. The stock market has been going up, and the mortgage rates have been following because the 10-year Treasury has soared up quite a bit from about 1.75 to 2.5% since the election.
And that's the main thing that you watch when looking at mortgage rates, is that 10-year Treasury?
Loosely tied to the 10-year Treasury. It's actually the mortgage-backed securities that is the definitive pricer, but it normally moves in the same direction of the 10-year Treasury. So Treasuries go down, rates go down, Treasuries go up, rates go up.
Is there any way to sort of anticipate where you think mortgage rates might be headed based on some of the incoming policies of the administration or comments of the administration?
My personal opinion is the market is somewhat already priced in a lot of the new policies. So I don't think we're going to see, a dramatic continued move because we've gone much quicker than anybody ever anticipated. So what I think may happen may settle down a little bit, and we're also seeing with the Fed tightening how that affects it. That happened last week, and last time the Feds did their tightening about a year ago, after about a week, rates actually started coming back down a little bit. So inflation is the biggest factor that tends to move the mortgage market. So if inflation's in check, a good chance we should stabilize or maybe gain back a little bit of what we lost.
Taking a step away from interest rates, just generally getting a mortgage for people who are looking into it or not aware of the options, how much nowadays do you really need as like a down payment for a mortgage?
There's a lot of different programs, and a lot of people say you need 20% down, but that's certainly not the case. On a conventional loan, you can do as little as 3 to 5% down. FHA loan, 3.5%. If you happen to be a veteran or in the military, VA offers 0% down, as well as USDA for rural properties where you can put no money down and still be able to buy a home.
You mentioned a couple terms there for anybody who's not familiar. So conventional and FHA, what does that mean? So
conventional is your traditional purchase programs that are going to be financed through Fannie Mae and Freddie Mac. A lot of people have heard of those organizations. And FHA is overseen by HUD. So those are going to be government-backed loans. Both of them are going to have mortgage insurance when you put less than 20% down. FHA is always going to have mortgage insurance no matter how much you put down. It's part of the HUD program. Whereas conventional, if you do put 20% down, there won't be mortgage insurance. Those are the majority of the programs that are out there. Then the other two we spoke about, VA is for veterans, the Veteran Administration, or folks that are in the military. And USDA is another government product by Rural Housing.
Yeah, talk a little bit more about that USDA, which that agency.
Most people think of food when you think of USDA, but there's a department that handles mortgage financing, and it's for folks that, and you don't have to be in the middle of nowhere. I mean, there's going to be areas in Montgomery County, Howard County, Carroll County that are going to qualify. So there's a map you look at, you put an address in, you go to the website, you put an address in, it'll tell you if it qualifies for USDA financing. And if it does, it's going to give you better, very good rates, very low mortgage insurance, and it's a really great program if the property. So it's going to be based on geography and income. You can't earn more than a certain amount based on the county, and it's got to be in a certain location to qualify for rural housing.
They're basically incentivizing people to spread out, so to speak?
It's been around a long time, so I don't know if I call it an incentive, but it's just a program that's always been out there. back in the day, I've been doing this 30 years, conventional underwriters used to cringe when an appraisal said rural on it. They always want to see suburban. So I think this is going back well before that, when a lot of lenders shied away from rural properties. So that's probably where it originally came from. But now those rural areas aren't so rural anymore.
Yeah. So on a mortgage, when you're looking at some of the numbers you might present to someone, are there rules of thumb to figure out whether that's an affordable plan that the person might be signing up for?
Everybody's budget's going to be different. Typically, we can qualify somebody on paper for is going to be more than they're comfortable affording, or more than they should be comfortable affording. Every conventional has certain debt-to-income limits. So does FHA, VA, and USDA. So I always try to start with the clients on what they're paying rent on. Are they able to live comfortably on that number? Are they saving money? So we try to find a budget that fits for them, and then go from there. But, unfortunately, the guidelines were supposed to tighten where it would be a little more common sense on affordability, but we can still normally qualify for somebody for a lot more than they really probably should qualify for.
So that's where some of the planning perhaps comes in on someone in your role.
Absolutely.
To make sure they have a good program.
Yep. We don't like to hear, how much do I qualify for? It's, because it's more, how much can you afford to pay?
Yeah, absolutely. We're going to take a break. We'll be right back. We're speaking with Ken Venick of Equity Mortgage regarding mortgage rates, interest rates over the last couple months and how they've changed. We'll be right back. You're watching Your Future, Your Finances.